Hey Jim, I have a question for you regarding individual 401k investing. I have both W-2 and 1099 income. I contribute the full $19,000 to my 401k from my W-2 income, and I have an individual 401k through Vanguard that I use to make pre-tax employer contributions. My goal is every year to put the maximum of 25% of my 1099 profits into my individual 401k. It's hard to know, however, exactly how much profit I will have after deductions and expenses every year, given that from year to year my 1099 income varies substantially. Do you recommend making monthly individual 401k contributions but lowballing the amount and making up the difference with a larger payment at the end of the year once I file my taxes? Or would you recommend just putting all future contributions into a high yield savings account throughout the year and making one lump contribution at the time of tax filing? What would happen if I were to contribute more than 25% of my profits throughout the year? Would there be a way to correct this at the time of tax filing? Would there be penalties incurred? Thank you so much for your help.
Okay, so Greg has W-2 and 1099 income. He's got a Vanguard individual 401k, which I've had before. It's perfectly good, plus his employer's 401k. But he wants to know how much to put in to the 401k, the individual 401k, because that 1099 income varies so much. And the truth of the matter is, you just do it all at the end of the year. It's very easy. Yes, you could do a little bit as you go along, but you want to make sure you're not putting in too much. So if you're halfway through the year and it's obvious you're going to make at least this much, then you can make a contribution for that much, maybe a little bit more. You could even kind of front load it, get it in the first quarter of the year if you're absolutely positive you're going to make that income during the year. But then you top it off at the end of the year when you know exactly what you've made with your 1099 income, because you don't want to over-contribute. The problem if you over-contribute is there is a 6% excise tax on those excess contributions. And that's for employee contributions. When you look at the employer contributions, which is what this is going to be for this doc, because he's already maxed out his employee contributions at his regular W-2 job. But when you look at the employer contributions, there is actually a 10% excise tax on the excess contributions. If you go to the IRS website, it says this: what are the consequences to employees if I make excess contributions? And it says excess contributions are included in the employee's gross income. Employees who withdraw the excess contribution plus earnings before the due date for their federal return, including extensions, will avoid the 6% excise tax imposed on excess contributions. Excess contributions left in the account after that time will be subject to the 6% tax on the employee, and the employer may be subject to a 10% excise tax on the excess non-deductible contributions. So if you contributed too much, you got a couple of options. The first one is that you can just distribute it to the employee yourself as taxable income, or you can retain it and pay a 10% fee on it. Either way, but I would just distribute it as taxable income, say, oops, that was a mistake. That's not really a 401k contribution. It's really taxable income. Pay the taxes on it. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.